your bank account looks fine. It isn't. The moment Saudi Arabia buried the petrodollar, your dollars started dying, just like 1971, when Nixon broke the gold promise overnight and Americans silently lost 50% of their purchasing power by decade's end. This video gives you the exact blueprint to get out before it happens again. The dollar in your wallet has a secret. It is not backed by gold, not backed by oil, and increasingly not backed by the trust of the nations that once had no choice but to hold it. For 50 years, the petrodollar system was the invisible architecture beneath every American paycheck, every retirement account, every mortgage. It worked like this. Saudi Arabia and OPEC agreed to price oil exclusively in dollars, which meant every nation on earth that needed energy had to first acquire dollars to buy it. That created an artificial, structural, and relentless global demand for the U.S. currency. That demand is what allowed Washington to print trillions without immediate, catastrophic consequences. That demand is what kept your grocery bill from tripling overnight. And in 2024, that agreement quietly died. Most Americans did not hear about it because it was not covered the way it should have been. There was no press conference, no emergency broadcast, no red banner across CNN. But the financial architects of this world noticed, and what they did next tells you everything you need to know about what is coming for your money. Here is what your financial advisor will not tell you, and what your 401k prospectus will never mention. The retirement infrastructure most Americans were handed was built for a world where the dollar was king by design, not by merit. Your 401k is denominated in dollars. Your IRA grows in dollars. Your savings account earns interest in dollars. Your Social Security projection is calculated in dollars. Every single financial instrument the average American was told to trust is a dollar-denominated bet. And when the dollar loses its structural global demand, every one of those instruments loses real-world purchasing power simultaneously. Without a single account being frozen, without a single bank failing, without a single headline declaring a crisis, that is the insidious elegance of currency devaluation. It does not rob you loudly. It robs you through the price of eggs, through rent increases, through the quiet moment you realize your retirement account balance is the same number it was 3 years ago, but buys 30% less. We have seen this movie before. When Nixon closed the gold window in August 1971, he did not freeze a single account. He simply severed the promise, and the consequences unfolded slowly, then all at once. By 1974, inflation was running at 11% annually. By 1980, the cumulative destruction of purchasing power had reached 50%. The people who ignored the structural shift did not lose their money in a crash they could see. They lost it in a decade they did not understand until it was already over. Now stay with me here, because in a few minutes I'm going to show you the specific moves that preserved wealth through that exact period, and why those same moves are being deployed quietly right now by the people who manage the largest pools of capital on the planet. But first, you need to understand what is happening in boardrooms and central banks that your portfolio manager will never bring up in your quarterly review. BlackRock, the largest asset manager in human history, with over $10 trillion in assets under management, began accelerating its allocation into hard assets, infrastructure, and commodity-linked investments starting in 2023. They did not announce this as a hedge against dollar collapse. They called it real asset diversification. But the timing is not coincidental. Central banks globally purchased more gold in 2022 and 2023 than in any 2-year period since the end of the Bretton Woods system. China's central bank added to its gold reserves for 18 consecutive months. Poland, India, Singapore, and Turkey all dramatically increased sovereign gold holdings. These are not countries making emotional bets. These are nations with entire ministries dedicated to reserve management. And they are collectively, methodically, and urgently moving out of dollar-denominated instruments and into assets that exist outside the dollar system. The question you must ask yourself is this: if the dollar is as safe as your financial advisor suggests, why are the most sophisticated institutional buyers on earth quietly building exits? The answer is that they understand something most retail investors do not. When a reserve currency loses its privileged status, it does not collapse in a single moment. It erodes. It loses purchasing power incrementally in ways that are easy to rationalize quarter by quarter until one year you look back and realize You were standing still while everything around you became more expensive. The smart money is not waiting for the crash. It is repositioning now while the crowd is still comfortable. And here is what that repositioning actually looks like in practical terms. The first practical move is physical gold, not paper gold, not gold ETFs, not gold futures, but physical, allocated in your possession or in a private vault. Gold. When the dollar loses reserve status, gold does not just go up in price. It becomes one of the few universally accepted stores of value that exists outside any government's ability to inflate or confiscate through monetary policy. In the 1970s, as the post-1971 inflation wave destroyed dollar savings, gold went from $35 an ounce to $850 an ounce by January 1980. That is a 24-fold increase, while dollar-denominated savings lost half their real value. The second move is commodity exposure, specifically energy and agriculture. When oil is no longer priced exclusively in dollars, energy-producing nations have less incentive to recycle their revenues into U.S. treasuries. That means less demand for U.S. bonds, higher interest rates, higher energy prices denominated in whatever currency replaces the dollar's monopoly. Owning stakes in energy infrastructure, agricultural land, or commodity-producing companies creates a position that appreciates precisely when dollar purchasing power deteriorates. The third move is the one most Americans never consider, and it is perhaps the most powerful: currency diversification. Not cryptocurrency, not speculative altcoins, but holding a measured portion of savings in currencies that are structurally positioned to appreciate against the dollar as its reserve dominance fades. The Swiss franc, the Singapore dollar, and selective emerging market currencies tied to commodity exporters have historically held purchasing power during periods of U.S. dollar weakness. This is not exotic financial engineering. This is what every multinational corporation and sovereign wealth fund does as standard practice. The everyday American was simply never told it was an option. The fourth move is the hardest psychologically, and that is reducing exposure to long-duration dollar-denominated debt instruments, specifically U.S. Treasury bonds. This is counterintuitive because for a generation, U.S. Treasuries were the safest asset in the world. But here is the brutal logic. If the dollar loses reserve demand, the United States must offer higher interest rates to attract buyers for its debt. Higher rates mean existing long-duration bonds drop in price. The people who will be hurt most by this are retirees and conservative investors who were told bonds were the safe portion of their portfolio. They are safe until the structural foundation beneath them shifts, and that foundation is shifting right now. Now, I want to tell you about the specific catalyst that could accelerate everything I just described, because it is not a distant hypothetical. It is already in motion, and most people will not recognize it for what it is until the window to act has closed. The United States currently carries over $34 trillion in federal debt. Approximately $7 trillion of that debt matures and must be refinanced within the next 12 months. That means the U.S. Treasury must go to the global bond market and ask investors to roll over $7 trillion at current interest rates, which are dramatically higher than the rates at which much of that debt was originally issued. The interest cost alone on this refinancing wave could push annual U.S. debt service above $1 trillion for the first time in history. At the same moment, the nations that were historically the largest buyers of U.S. Treasuries, China, Japan, and Saudi Arabia, are all reducing their Treasury holdings. China has been a net seller of U.S. Treasuries for multiple consecutive quarters. Japan is dealing with its own currency crisis and cannot absorb U.S. debt at the scale it once did. And Saudi Arabia, freed from its petrodollar obligations, has less structural incentive to recycle oil revenues into dollar assets. This creates a collision of supply and demand in the U.S. bond market that has no modern precedent. The Federal Reserve will face an impossible choice: allow interest rates to rise to levels that would trigger a debt spiral and a recession, or restart quantitative easing, print new money to buy the bonds no one else wants, and accept the inflationary consequences. Either path leads to the same outcome for the dollar: loss of purchasing power. One does it through economic contraction, the other through monetary expansion. Your savings account earns interest either way, and that interest will not keep pace with what is coming. This is not a prediction. This is an arithmetic problem, and arithmetic does not care about election cycles. central bank communication strategies, or the confidence of financial commentators on cable television. What you do in the next 12 to 24 months will define your financial position for the decade that follows. The people who acted in 1971, who bought gold, who moved into hard assets, who refused to remain entirely dollar-denominated, did not just preserve their wealth. They multiplied it while everyone around them wondered why their savings felt smaller every year, despite the balance never changing. You now have the same window. It is open. It will not remain open indefinitely. The system is not designed to warn you when it is about to lock you out. It is designed to look stable until it isn't. This channel exists because someone has to say it plainly before the window closes. Subscribe now, because when the next structural shift happens, you will not read about it in time to act. You will only read about it after. And this channel will not let that happen to you.